Hey folks, welcome to another product review at Finominal. Today we're going to do something special. We're going to look at an equal cap weighted version of the S&P 500. Specifically, we're going to use an ETF from Invesco, which has a ticker RSP. It charges 20 basis points and manages around 40 billion of assets. So we frequently get the question if investors should prefer a market cap weighted or an equal cap weighted version of an index. And so we're going to explore this topic a little bit today. There's pros and cons. And we're going to kick off by looking what the right benchmark is for RSP. Now, intuitively, you might argue, hey, it's S&P 500, and for the equal cap weighted version, it should be the market cap version. Having said that, technically speaking, the suggested benchmark is actually the Russell 1000 value index. And we can demonstrate that by the higher R squared. So you have an R squared of RSP to the Russell 1000 value index of 0.96, which is higher than to the market cap weighted version of the S&P 500. And the tracking error is lower compared to the market version. Having said that, in terms of performance, RSP actually has outperformed both since inception in 2004. And for the remainder of this analysis, we're going to actually stick to using the market cap weighted version of the S&P 500, simply because I think this is perhaps technically incorrect. This is what investors are practically going to do. Next, we're going to have a look at how similar the market cap weighted and the equal cap weighted versions of the S&P 500 are from a holdings perspective. So we're going to go to Securities Analyzer and do a quick funds overlap analysis, where we see effectively that both ETFs, I'm using SPY as a proxy for the S&P 500, the market cap weighted version, have around 500 stocks, slightly more than that, which might be surprising given that it says S&P 500, but that is explained by the A and B shares of some companies like a Berkshire Hathaway or an Alphabet and so on. We also see that the overlap between RSP and SPY, or the S&P 500, is only 49%. And that, of course, is explained that in the market cap weighted version of the S&P 500, the large tech stocks, or Magnificent Seven, as they're currently called, have a much larger weight, because in the equal weighted version, as per definition, they have all the same weights. Now we can demonstrate that by looking at a breakdown by sectors and see where the key differences are. And overall, there are perhaps less differences from a sector perspective than expected. In a lot of them, it's pretty much very similar weights: consumer discretionary, consumer staples, energy. However, there are two big discrepancies. The first one is financials, where the equal cap weighted version has a 19% weight compared to 11% for the market cap weighted version. And then the equal cap weighted version has an underweight in technology compared to 36% for the market cap weighted version. Now, that's quite interesting for investors that are concerned with the high multiple for the S&P 500, in the sense that it's expensive currently, which can be mainly contributed to those large technology companies. And if you do want to have exposure to the S&P 500, but get it at a lower multiple, you might consider the equal cap weighted version for that. Now, one way to demonstrate this or measure this a little bit more, the expensiveness, is by doing effect exposure analysis. And we're going to take RSP here. And again, going to stick to the market cap weighted version of the S&P 500 as a benchmark. And what we can see here is, from a value perspective, it's slightly positive, as you can see. And the other key exposure is that, of course, there's consistent positive exposure to the size factor over time, because the large companies have an equal weight rather than the larger weights as the S&P 500. There's also slight negative exposure to quality factor and kind of mixed exposure to low volatility. It is worth mentioning that the magnitudes of the factor betas are on the lower side, because overall the market cap weighted version and the equal cap weighted version are still very similar. Now, the final question that we're going to look into is which one is riskier. And often we get the comment that the equal cap weighted version is riskier when stocks crash or decline. And interestingly, that is not true. So we can go to the diversification booster and look how both versions of the same index have performed over time. For example, during Lehman Brothers. And yes, there are periods where the equal cap beta version has performed worse, for example, during the global financial crisis in 2008. Having said that, there are also plenty of periods, for example, during 2015 or here during the Greek debt crisis, or actually most recently during the sell-off last year, where the equal cap beta version had a lower drawdown than the market cap beta version. Now, that kind of like wraps it up from our perspective. So the equal cap beta version of the S&P 500 is interesting, given that it certainly has not underperformed. Of course, always depends on the time frame. It is a good alternative to the market cap beta version for investors that do want to have a low exposure to the technology stocks and have a lower multiple that they're paying for. And from a tracker perspective, it's also not a riskier proposition. Now, this only goes back about 20 years, 20 years or so. There's plenty of research that shows that over decades, these results also hold true. So that's it for this perspective. I hope this was useful. Have a nice day.